Hey everyone, welcome back to Corporate Decoder, the place where we take complex financial documents and make them make sense. So today we've got a big one, a 10K filing from MID. America Apartment Communities Incorporated and its limited partnership subsidiary, their annual report is packed with details on their properties, their finances, and even some juicy risk factors, you know, the kind that keep executives up at night. So buckle up because we are going to decode this thing and find out what is really going on behind those apartment doors. And if you love getting these straight up insights from SEC filings, make sure you are subscribed. We also have a Discord community linked in the description below where we break down these documents even further. Alright, first things first, let's get a feel for this company MID. America Apartment Communities Incorporated, or MAA, as you'll see. It referred to throughout this filing is a big player in the apartment world. They are what is called a real estate investment trust, or REIT, which basically means they own and operate income-producing real estate, and their focus is on multifamily apartment communities mainly in the southeastern, southwestern and mid-Atlantic regions of the United States. As of the end of 2025, they owned or had a stake in over 300 apartment communities with more than 100,000 units. That is a lot of apartments and a lot of tenants. This 10K filing is their annual report for the full year ending the 31st of December 2025, and it gives us a deep dive into their financial health, their strategies, and the risks they openly admit they face. Now let's talk about the money. The company reported total assets of nearly $12 billion at the end of 2025, a slight increase from the year before. But it is their real estate assets that form the core of their value. This is where they sink most of their money. Around $11.6 billion is tied up in land buildings and improvements. And properties currently under development, that is a heavy investment in physical property, showing their core business strategy is very much tied to the tangible real estate market. Looking at profitability for 2025, Mid-America Apartment Communities reported net income available for their common shareholders of about $443 million. This is actually down from over $523 million in 2024. So while they are still incredibly profitable, they did see a dip in their bottom line this year, which is something we will want to explore further. Let's break down where that money comes from. Their total property revenues were just over $2.2 billion in 2025, a small increase of about 0.8% from the previous year. This revenue comes from two main segments. The same store segment, which includes properties they have owned for a while and are essentially running like a well. Oiled Machine brought in just under $2.1 billion in revenue, but it actually saw a tiny dip of 0.1% year over year. The real growth came from their non-same store and other segment, which jumped by a significant 18.9%. This tells us they are actively acquiring new properties or developing new ones that are contributing more to their top line. The same store segment is really interesting because it shows the core operational performance of their established properties for 2025. The net operating income, or NOI, for this segment was just over $1.3 billion. This is a slight increase of about 0.03% compared to 2024, meaning their existing apartment buildings are performing remarkably consistently in terms of generating profit after operating expenses. But it is important to note that average effective rent per unit actually decreased by 0.5% in this segment, which suggests they might be using some leasing concessions to keep those units filled. On the expense side, property operating expenses, excluding real estate taxes and insurance, saw an increase of 2.2% year over year, reaching over $837 million in total. The company mentions that personnel, utilities, and building repair and maintenance were the main drivers in their managed properties. Those are costs that tend to go up with inflation and increased operational activity. So if we look past some of the off events like property sales, legal settlements, and those preferred stock adjustments, we can see how the company's core operations are doing. Their core funds from operations, or core FFO, a measure that many in the REIT industry use to gauge operating performance attributable to shareholders and unit holders, was about $1.05 billion in 2025. Slight decrease from 2024. This dip is mainly due to those rising property operating expenses and higher interest expenses on their debt. Now about that debt, as of the end of 2025, their total debt was a hefty $5.4 billion. But importantly, they had over $60 million in cash and cash equivalents, which brings their net debt down to about $5.3 billion. They also proudly mentioned that their net debt to adjusted EBITDA ratio, which is a measure of how easily they can pay back their debt, was 4.3 times, a ratio they aim to keep healthy to maintain their investment grade credit ratings. To me, this shows they are managing their debt prudently, but it is still a significant amount of money. The vast majority of their debt, around $5 billion, is unsecured, meaning it is not tied to specific assets, making it more flexible, but also potentially more expensive to borrow compared to secured loans. They have been actively managing this debt, issuing new notes and retiring older ones as they mature, aiming for a good mix of fixed and variable rates. to manage interest rate risk. Let's talk about shareholder value. Their common stock is traded on the New York Stock Exchange under the ticker MAA, and as of the 31st of December 2025, over 116 million shares were outstanding. The good news is they have a history of paying dividends and even increased their expected annual dividend rate to $6.12 per share for 2026, which is always a plus for investors. However, they also mentioned they have a share repurchase program and did buy back some shares in the last quarter of 2025, which can boost shareholder value by reducing the number of outstanding shares. Now let's get into the juicy stuff, the risks. This company is very upfront about the challenges they face, and they have quite a few of them. First, obviously, is the broad economic climate. Unfavorable markets and economic downturns could hurt their occupancy rates, rental revenues, and property values. Basically, if jobs are scarce, people rent less and pay less. This is a pretty standard risk for any real estate company, but it is worth noting that about 41% of their portfolio is concentrated in just 5 major markets. This means if those specific areas hit a rough patch, it could really impact their overall business. They also face environmental risks like potential contamination from past owners, or even future issues that are hard to predict, and remediating these problems can be incredibly expensive. They have environmental studies for new properties, but they admit there is no guarantee these studies will uncover every single potential problem. And then there are the cybersecurity risks, which are becoming more and more prominent in every business today. They rely heavily on its systems to manage everything from leasing to resident data, and a breach could be disastrous for their reputation and operations. They are investing in security measures and have policies in place, but like they say, no system is perfect, which is a constant threat in today's digital world. Finally, we have some legal woes. They are involved in a significant lawsuit, or rather a settlement related to allegations of price fixing with rent management software called RealPage Inc. This is a big one, and even though they have agreed to a settlement for a substantial amount, we are talking $53 million twice, it still needs court approval. There is a chance this deal could fall apart, leading to continued legal battles and uncertainty. On top of that, there are other lawsuits from states like District of Columbia and Kentucky, all pointing towards potential antitrust issues. So while they are a giant in their fields, they are definitely navigating some choppy legal waters. Looking at the big picture, America Apartment Communities, or MAA, is clearly a powerhouse in the multifamily real estate market. They have a strong track record, a solid portfolio, and a clear strategy for growth through acquisitions, development, and property enhancements. Their financial results are impressive, with high revenues and significant operating income. However, they are not immune to the broader economic risks like interest rate hikes and potential downturns, and the legal cloud hanging over them. With the RealPage litigation is something to watch closely. The slight drop in net income is a clear indicator that costs are rising, and perhaps the rental market is not as red hot as it once was. Even with strong occupancy, they saw a dip in average rent per unit in their same store properties, which could be a sign of increased competition or market saturation. They are also making significant investments in new developments and technology, which, while good for long-term growth, also come with upfront costs and risks. So is this a good investment? MAA has proven resilience and a strong business model that has rewarded shareholders for years. The dividend payments are attractive, and their management seems proactive in navigating market challenges. But investors should be aware of the rising operating costs, the substantial debt load, and the potential financial and reputational impacts of those ongoing legal proceedings. It is a mature company with a lot of strengths, but potential headwinds that need careful consideration. The question really is whether they can continue to drive growth and manage costs effectively in a potentially tightening economic environment. Alright, that's our breakdown of Mid-America Apartment Communities 10. Okay, filing, what are your thoughts on these numbers, and what do they signal about the company's future? Let us know in the comments below. If you found this analysis valuable, hitting that like button really helps the channel, and subscribing ensures you don't miss out on future deep dives into corporate filings, and definitely check out the Discord in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.